Costco makes almost no money selling you groceries. 3 cents on every dollar. A rounding error compared to Apple.
And yet, $100,000 invested in Costco in 1992 would be worth over $7 million today.
Same story, every time. The business that looks weak on paper is quietly crushing everyone.
Most investors see a thin margin and run.
They think profit percentage equals quality. But Costco proves the exact opposite. By the end of this, you'll understand why the thinnest margin in retail built one of the widest moats in the world. Here's the stat that stops people cold. Costco's operating margin sits around 3.3%. Walmart runs higher.
Apple runs near 30%.
On a spreadsheet, Costco looks like the worst business of the three. But look what happens when you follow the money.
In fiscal 2024, Costco pulled in about $254 billion in revenue.
Thin margin, enormous volume. That's the trick hiding in plain sight.
And here's the part nobody tells you.
Costco doesn't actually make its profit from selling products at all. Think about the last time you shopped at Costco. You paid to get in the door.
That membership fee is $65, or $130 for executive, that's the real engine. In fiscal 2024, Costco collected about $4.8 billion in membership fees.
And that money is almost pure profit. It flows straight to the bottom line. So Costco can sell the hot dog and soda combo for $1.50, the same price since 1985, because it isn't trying to profit on the food. The low prices are the bait. The membership is the business. Now here's a question for you. Which company do you trust more, one that squeezes you on every sale, or one that makes money only when you keep coming back? Tell me below. This is the part most investors get completely backwards. They think a fat margin protects a company. It's actually the opposite. A fat margin is an invitation. It tells every competitor, there's room to undercut you. Costco does the reverse. It caps its own markup. Most items can't be marked up more than 14 or 15%, even if they'd sell for more. That self-imposed ceiling means no competitor can meaningfully beat Costco on price. There's no room left to cut. And the loyalty shows up in the numbers. Costco's membership renewal rate sits around 90% in the US and Canada. 90%. That's not a store. That's a subscription people refuse to cancel. Remember what I said at the start, the thin margin is the moat. This is why. The low price isn't a weakness Costco tolerates. It's the wall it builds on purpose. Charlie Munger sat on Costco's board for years and called it one of the businesses he admired most. He understood something simple. A company that earns a customer's trust keeps that customer for decades. Watch what that trust does over time. Costco has grown from a single warehouse in 1983 to over 890 locations worldwide. Each one a machine that turns low prices into lifetime members. And the stock reflects it. That $100,000 from 1992 didn't just grow, it compounded, quietly, for over 30 years, while the flashy high-margin darlings came and went. This is educational, not financial advice. Always do your own research. But the lesson is timeless. Value doesn't announce itself with a big margin. Sometimes it hides in the smallest number on the page. Remember what I promised you at the start. The thinnest margin in retail built one of the widest moats in the world. Costco proved that a great business isn't the one that takes the most from each customer, it's the one that gives so much value the customer never leaves. Here's the line to carry with you. Price is what protects a weak company. Value is what protects a great one. So did this flip how you think about profit margins? Yes or no? Drop it in the comments. And tomorrow, we're breaking down the one number on a balance sheet that quietly predicts bankruptcy years before it happens. You won't want to miss it.